Hey guys, this is Scott Horne with Horne Associates PC, and I'm just going to talk a minute on this video about buying and selling a note. Now this is going to be both from a legal perspective, but also from a real estate perspective, and kind of blend it all together. So I hope you like the video. If you do, please like it for us. Make any comments, we'll do our best to get back to you on those. Please see us over on our YouTube channel as well, and join. So let's just jump right into this, because I love the business of buying and selling notes or mortgages. It is traditional and it is ordinary. For those of you that own a homestead, you know, the great odds are the mortgage company lender you closed with isn't your current lender today. Typically in the business, you'll close with lender A on Monday, and by Wednesday or Thursday, it's been sold to another lender out there already. In the investment world, it's the exact same thing, but they do look for some more items than what the traditional mortgage market does that is out there. This is a great business to be in if you are an investor. So if you're going to buy or sell a mortgage, the first thing, of course, you need a good mortgage. That's going to be your note and your deed of trust. You want to make sure it complies to all of the state standards where that loan was originated. And what people look for initially in buying a note is they're going to look for what's the interest rate on it. They're going to look at what is obviously the loan balance. They're going to look at the seasoning. Seasoning is how many payments are out there. And traditionally, to sell a mortgage, most investors want to see a minimum of 12 months. 24 months is kind of your sweet spot or more. And of course, the more seasoning you have, the better the pay history of your buyer that you have, the higher price that they're going to offer you. Now, keep in mind that investors who buy notes are looking for certain yields on their investment. Are they looking for a 9% return? Are they looking for 10, 12, 14, 16, something else? Who knows? Another thing that you have to look at and consider is what is the actual loan to value of your loan? Obviously, there's an initial down payment, but so often investors may sell their houses at 100 cents on the dollar, maybe 105, 110 cents on the dollar, something like that. So if you sold it for 110 cents and you got a 10% down payment, your buyer's loan is 100 cents on the dollar of value. Note buyers are not going to pay you 100 cents on the dollar out there. They're going to want a factor of safety, because in the event of a foreclosure, I can tell you right now, 85 cents is probably the max loan to value they're going to be in that deal at, because that's about your break even by the time you get a house back through foreclosure, non-payment, get in, make some minor renovations, sell it, pay your closing costs, holding times, just to get your money back out. So that's a very important thing to understand when you're looking at selling a mortgage. Now, of course, the longer that buyer has been in the house, 5 years, 8 years, 10 years, it's more consistent. There's less risk that they're just going to move out and walk away. And in those scenarios, there usually is substantial equity, and the buyers aren't going to walk away from that too. So you're limiting the risk that the note buyer is going to have. So note buyers, again, they look at the document itself, the note, the deed of trust, for the collateral. They want to look at the interest rate of the loan. They want to look at the pay history. I mean, how has the buyer paid over what time frame, and the longevity of that. They want to see what the actual market value of that property is versus what the borrower owes. And all those things are going to go into the equation. So it's not just a return on investment, but it's also a risk assessment scenario that investors are going to go through. Now, one of the things that has changed in years regarding notes is you go back to the 1980s, and yes, I'm dating myself a little bit. We didn't have loan processing and things like that, and people would still buy notes so long as it looked decent. One thing we found as the business started coming into maturity from selling investment notes was processing the buyer, getting basic financial information, getting your standard 1003 application, getting tax returns, getting a VOE or a VOM. Those are verifications of employment, verifications of mortgages. We would document our package basically to show what our buyer, our occupant had. How did they pay their rent? And by getting what was called a more complete package, or a pretty package is what we kind of called it back in the day, we were able to maximize our dollars quite a bit versus having nothing. Come fast forward now in today's compliance world. We have to deal with the SAFE Act, Dodd-Frank, RESPA, etc. All of a sudden, all this has become hyper-focused into the creative finance world. And all this is going to be important. So if you want to sell a seller finance mortgage, you better have a loan processing package on your buyer. If you don't have it, you may not even sell it at all, or you're going to get cut off at the knees because you don't have it. There's going to be a whole lot more risk involved because a person that buys your note possibly could take on liability for the origination of that note, and they just don't want to deal with that today. So if you want to maximize your dollars in selling a mortgage, besides the things we've already talked about, make sure you get that borrower processed before you sell the home, meet those rules and obligations, make sure the debt to income ratios are reasonable. Those are the buzzwords. Consider and verify a borrower's financial ability to repay the loan. We investors don't have the same rules and regulations the big banks have, which is basically a 43% or so max DTI. We have a reasonable standard. But if your reasonableness is 70% DTI, guess what, guys? Your note buyers aren't going to touch it. So you've got to keep those kind of things in mind, have that good loan processing package along the way. Now, once you understand how the dynamics kind of work in the note world, and I will tell you this, there are corporate note buyers, there are banks that buy these, there are IRA people who buy these, all types of people, and what they look for is different. So one of the things you've got to do is got there and canvas the marketplace in who is looking for what and what is available. Now, once you know what the marketplace is going to offer, you're ready to do this, you've got your seasoning and things of that nature that is out there, you want to make sure that you go to contract with a proper contract. Most note buyers are going to want title insurance on your deed of trust. You don't necessarily have to get it with your buyer day one. You can get mortgage title insurance issued several years after that loan has been originated and recorded. It's just that they're going to issue that insurance based on today's numbers, not on when it was originated. You want to make sure you disclose all the proper terms of your mortgage in that contract to your note buyer. They're going to want to check title, make sure things were originated properly and correctly, that it's a valid subsisting mortgage that is enforceable. A lot of note buyers are going to want appraisals to be involved in the business as well. That's one of those things that you just have to expect and anticipate in anything that we do. They want to be able to have all this together. They want to see the mortgage documents in advance. They want to see the loan processing in advance so that they know what they're going to be buying. They have a chance to evaluate it properly. The sale documents for a mortgage are really pretty straightforward, guys. It's an assignment or a transfer of that lien. It is an endorsement of the mortgage. An endorsement is really simple. Pay to the order of, just like you're endorsing the back of a check. You can either write that on the note that way. You can use what's called an Allonge, which is an attachment to the note, which is attaching the endorsement. Those are really the same things along the way. But just getting a feel for that, that's all you have to do. Now, oftentimes they're going to want to make certain that that mortgage is in first lien position. They probably don't care what's behind it. They care to make sure that it is in first lien before they go out and buy it. Obviously, if you have a title insurance, they're good with that. Or if you're going to get them new title insurance, they would be good with that as well. So getting a feel for how the mortgage game works, there is a wide fluctuation in what people pay you. You know, are they going to pay you the low mid 90% of the loan balance? Maybe. It's based on multiple variables. Are they going to pay you in the low 80s? Again, multiple variables. Most note buyers don't look at the buyer's credit. They're looking at pay history, loan to value, return on capital and investment, risk assessment, where is it located, neighborhood, processing, all these kind of things. But this is an awesome business, guys, to be in. I love talking to investors about the note game because playing the note game right, you can easily 2x, 3x, 4x your profit over and above a traditional fix and flip or wholesale transaction by having the ability to not need that instant gratification of a profit today, but holding for maybe 2 years and selling your mortgage properly and correctly. You can legitimately maximize your dollars where you are able to pay your debt down, So you don't make any money in that time frame, but you wind up making a legitimate, 2x, 3x, 4x profit, which becomes just awesome because there's no way to take the money you would make in a traditional wholesale or fix and flip scenario and invest it and double your money or triple your money or quadruple it even in that type of a time frame that's out there in, say, 2 years. So take the time, investigate the creation of, the marketing of, the sale of a mortgage, how that works. It is a phenomenal business practice for real estate investors who are in the single family and even in the commercial world as well. I'll make one last comment about notes. Most note buyers really want to deal with notes that are owner occupied versus investor notes. Owner occupants tend to live in their houses better. In the event of a real estate crash or something that happens, investors can walk away from their investment property, but homeowners, the last thing anybody walks away from is their home. And so if you're trying to sell an investment note versus an owner-occupied note, you will be getting probably substantially less money for it than you would for if it's an owner-occupied transaction. But at the end of the day, guys, it's a fun business. It's an awesome business. It's how you can really help generate wealth by doing things properly and correctly and taking the time to understand the industry. I think it's a great tool for your tool belt. It'll help you really maximize your dollars. So guys, I hope you found the video helpful. If you did, please like it. Make any comments, we'll get back to you on those. Come see us on our YouTube channel and join us there, and we'll see you guys next time.